another episode of Investors Guide. Thank you so much for tuning in. Over the next half hour, we'll give you all of the advice you need to navigate what's going on in our market, whether that has to do with special charges from your bank or with movement in the stock market. All of the advice is right here. So is our email ID, which is at the bottom of your screen. We're going to start off by telling you if gold funds make any sense at all, and if that's something you should continue investing in. We'll also look at the Mirae Asset Emerging Bluechip, and we'll help you decide whether this is the right time to invest in debt funds. So we bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. I want to start off, obviously, by talking about a topic that you picked up and that's become something we must discuss. We also had Aditya Puri of HDFC Bank come out and say, I'm not a free service. If you want service from your banks, you should be willing to pay for that service. So I don't think the question is whether or not customers want to pay for services in banks, but how that service is being paid for and how ethical the bank's treatment of customers are right now. In your opinion, do you think that all of the banks, private and public, are treating customers fairly at this point?
No, not at all. In fact, all the examples that I have cited in my column actually reveals a completely different story. People are being shortchanged. Banks are behaving like pickpockets. And this is, we need a regulatory intervention because I have no problem with cost. And I fully understand that banks are not in the business of charity. I'm not expecting a charitable behavior from them. I want them to be charging me reasonable on some basis. There has to be some premise. Have they done any costing? Is there any RBI framework around this? I don't want RBI to regulate the pricing, but I definitely want them to, give me some indication, the basis of, the cost of withdrawal. Of course, they have to really worry about it and they should change the model. Also, many of the way that these banks conduct, the particular example which I cited, that a mail being sent to a customer, and the default was that, on not responding, it will be deemed as he has accepted the terms. And he started, you just look at the story that we have, the same column put on my website, and we are getting hundreds of responses on that, and everybody is sharing his, story. I have no problem with, a bank, and this is the essential service. I think I would expect our Reserve Bank of India to give some framework, and also, no other business in this world ever charges for any service, takes money from my wallet directly. Because I have entrusted my money to the bank, that doesn't give them authority to actually debit my account anytime at their choice. Today in this world of technology, I'm giving an authorization, and it is reasonable for any customers to expect that before any money is debited by the bank from my account, somebody should be taking my express permission. And if not, they are not supposed to charge. I don't go to any other shop and say that, take this bread and I'll take the money from you. It doesn't work like that.
The case that Dhirendra is specifically referring to is the case when the bank, specifically in this case HDFC Bank, has sent out emails to all its customers saying you are going to be charged about 100 rupees as fees for the personal banking or for the banking advice that you're getting. If you don't want to be charged this fee, scroll down at the bottom of the email and press the button that says I don't want to be charged. Now, a lot of times this basically means that if the customer has not read the email carefully or not pressed that button, the bank will begin taking 100 rupees out of your account on a regular basis. And there is an ethical issue with that, because I didn't sign up for the service, I didn't agree to pay you 100 rupees. You are taking the 100 rupees from me just because I have not said no yet. And that is the problem. The other problem, Dhirendra, is from what is called MDR, or the merchant discount rate, which is a rate that gets charged to us every time we swipe our cards. Now, according to HDFC Bank here, again in this case, they're saying that if you're swiping your card at the Taj, or if you're swiping your card as Louis Vuitton, then you shouldn't have a problem with paying. But that's not the problem. We live now in a country where we are expected to swipe our cards more and use less cash. How is it possible, and in what sort of vulture-like predatory behavior will banks start making money off the fact that we are now in a cash or a less cash system and charge us for every swipe? That's completely unethical.
No, we have a way around it, and actually that is the business model. If you look at the Visa, MasterCard and the arrangement that we have, that is the mechanism. So I don't think there is a way around that, and I'm not objecting to that. people will have, it will take some time for us to, it will take some time for rupee cards to become mainstream. And that is a low cost alternative that will fulfill many people's need. And I think one should start exploring the expensive, there should be a mechanism, and we at Value Research will definitely be doing it in terms of evaluating banks on their cost and services, which will eventually translate into some kind of indication in terms of banks to avoid, because and there are a reasonable number of good banks which will also be reasonable with the cost and adequate service. I'm not saying the particular reference that Mahesh Lunch Home and Oberoi's. We understand the difference. But first I really want to know the premise of this costing. There has to be some basis to some cost to costing of something which is essential to which is an essential service delivered by any bank. Is there a framework to it? Then comes customers should have a choice of moving away from banks which are unreasonable, which are unfair, and they should be able to derive 90% of the services without the nonsense, without the fear of their money being stolen continuously. That I think is the way around it, and I would expect that a lot of people will wake up to this reality. RBI will take note and come up with some framework in terms of cost for essential banking services delivered, which is depositing money and taking withdrawing cash.
Depositing money and withdrawing cash. And remember, as a banking customer, one of the things you must do is read every email that comes from your bank and read it very carefully, because if you do not read your email, then that is on you, and the bank will say it sent you an email and you did nothing about it. So now you have to make sure that every time you get an email from the bank, you read it very, very carefully. And of course, this is something that we'll be taking up here on the show. Let's move on to some questions. Anand Kumar has written in. He's been investing each other's 10% of his monthly savings in gold through gold ETFs. He has noticed lately that the price in the secondary market is at times lower than a new tranche. He wants to know what is the difference between buying in the secondary market as against buying a new tranche. And I want to start this question by broadening it a little bit and asking you, do you think gold ETFs still make sense? At 10% of this gentleman's portfolio, do you think it makes sense for him to continue this investment at all? And then we will answer the next question.
No, as I have said time and again, and I've been saying this for all these years, that gold doesn't make sense. It's not a great investment at best, and people in the boom time, they were able to find or invent a reason that, it is a diversification. I was also, for a brief period, I was so got carried away by the momentum of gold that I said that, okay, I also contributed to that invention that, if you need to buy gold at a future date, maybe, do accumulate and exchange it with gold, just in case there is a runaway, the prices run away. But I think, the fundamentals that gold is not a productive asset, and that is why it should not be a long-term holding. It should not definitely be a 10% of your portfolio. And most important thing that today, after the launch after the start of the sovereign gold bonds, I don't think there is a case for the gold bonds, gold funds or the gold ETFs. One should not have them. Just in case you need to have gold in the financial form, the only way you should have it is the sovereign gold bonds, because it serves the purpose. You are able to ride the gold prices, at the same time earn 2.5% annually more. All other investment avenues for gold, the gold ETFs and the gold funds, are a mechanism whereby you will be able to ride the gold prices, less expensive, and that could range between 0.5% to 2%, plus some inefficiency. So this is, gold should not be held generally by any investor as an investment.
There's also talk about the question that Anand Kumar is asking, which is that sovereign gold funds are paying an interest that's not available on ETF. Does it make sense to move to the sovereign gold fund? Particularly because he noticed that there is a 0.25% advantage there. Would you recommend, if he's still so convinced about gold funds, that he should move to the sovereign gold bonds instead?
Yes, I would urge him to, not go up to 10%, depending on what his 100% is. But yes, as I said earlier, that of all the financial investment avenues in gold, sovereign gold bonds look most promising and will perhaps be most rewarding. And I think its safety can't be matched by anything, because a bond offered by Government of India, which will ride the gold prices, no other instrument can actually match that safety.
So if you really want to invest in gold, then the sovereign gold bonds make most sense because they're of course guaranteed by the government of India, and they give you that slightly higher interest rate that you don't get on an ETF. We have a question from a 42-year-old with 2 dependents and a home loan, Dhirendra. This is Prakash Chandra Joshi who's written in. He wants 1 crore rupees on his retirement and 50 lakh rupees for his daughter's education in 5 years' time. So that's a short-term investment. Monthly saving of 30,000 rupees. He has a PF from his office, 50,000 rupees going into the PPF right now in its 13th year, and 12 lakh rupees in mutual funds per year. He also has bank deposits and a term insurance. Medical insurance also looked after for the whole family. If we look at his portfolio, the thing that I'm concerned about is that he only has 5 years to go before his first goal of 50,000 rupees for his daughter's education. How should he approach that now, given the market that we're in? What kind of growth do you think we can expect from our mutual funds in the next 5 years, Dhirendra?
Given that, I'm not very unsure of, reasonable return, at least fixed income beating return, even from these levels over the next 5 years. But the real problem is his total allocation. He has a very nominal amount and a very small amount going into equity. His provident fund accumulation itself is about 15 lakh. He has 18 lakh in a fixed deposit, and he has his PPS. So it's dominantly fixed income, and rest of the money going into equity, which is about 3.5 lakh rupees a year, which I don't think he will still be able to achieve the target that he has set, that 50 lakh rupees for education of his daughters in 5 years' time, and 1 crore for his retirement. But I'm afraid, given his scale of income and savings and his expense requirement, that may not be enough 15, 20 years from now. He will be able to achieve that goal, but that may not be enough, given that, we are actually looking at 1 crore from today's perspective. But the amount of income it will generate when you need it 20 years from now will not be adequate, and fixed income returns are on a decline. The money which he requires for his daughter's education, he should think in terms of having only the amount that he needs in the first year at the time of admission, because that money will be required periodically annually. So he should have that money in the fixed deposit, so I am completely sure of that. And rest of the money should be invested in a balanced fund to that goal. And next year onward, he should take out money, to the extent that is needed, so that he is not worried about that goal, because that is not a negotiable goal. He needs the money when it's needed. And discontinue his PPF. Invest only to the extent that is needed. He has accumulated reasonable amount of fixed income in his provident fund. He should stop that. He should only have fixed income to the extent that will act as a reasonable cushion as an emergency fund, and over provide for it. Beyond that, I think, this 18-year period, what you have for retirement and any other long-term goal that you have, he should invest much more, allocate much more to equity funds, be methodical about it, never invest lump sum, more so now. So even the money which has to, lying in fixed deposit, so he needs some careful planning and a cash flow requirement estimation, and approach it methodically.
Need some regular planning, and of course, Dhirendra said, keeping an eye on the fact that you have one goal coming up in 5 years and another one coming up in a slightly longer period of time. Dhirendra, here are the funds he's using: the DSP BlackRock Top 100, the IDFC Premier Equity Plan, HDFC Prudence, HDFC Top 200, Reliance Equity Opportunities. Are these the right funds for him, and would you like to divide them between the ones he should use for his 5-year goal, which is his daughter's education, and the ones he should be using for the longer term retirement planning?
Yeah, absolutely, and he definitely needs to be segregated, and this needs to be segregated very objectively. He needs to be in conservative funds. So, the money which is likely to be needed in the first year at the time of admission should be in a fixed income fund. Then the allocation and the money from which he will withdraw after 1 or 2 years for subsequent year expenditure for education, that should be invested in a balanced fund, because that will still be 5-6 years fund. And his retirement fund should be a multi-cap fund, 1 or 2 multi-cap fund where he's investing aggressively and regularly, not lump sum. So 2 balanced fund and 2 multi-caps for 2 different goals.
We balance funds into multi-cap for different goals. And also what I'm going to do on the screen is I'm going to put up our recommendation that Dhirendra has picked for this year, which is balanced funds and multi-cap funds for the year. We're going to take a quick break. On the other side, we'll talk more about mutual funds, but a quick recap of what we've learned so far. Every email that you receive from your bank, you need to read very, very carefully and look for hidden charges that the bank might be taking straight out of your bank account. Also, avoid gold as far as possible unless you're absolutely convinced that you want to invest in gold. Then the sovereign gold bonds released by the government is probably a very good idea. Dhirendra is still with us, and it's time to look at our product review. This week, we're looking at the Mirae Asset Emerging Bluechip.
Thanks, Faye. This week, we take a look at the Mirae Asset Emerging Bluechip Fund. With a 5-star rating on value research and just about 3,200 crores as assets under management, let's quickly take a look at its performance over the last 5 years. The red line is the fund and the blue line its benchmark. You'll see that the fund has always managed to do better than its category and benchmark. In fact, in the year 2014, the fund was at its best with a return of 85%. Even in the year 2013, when the category was a negative 5%, the fund gave a return of 9%, performing much better than its peers. A quick peer comparison of the fund shows that this has performed better than all the other funds in its category and in the long and the short haul as well. Interestingly, however, the fund has been closed for subscription since October 2016. What this essentially means is that the fund has stopped accepting fresh lump sums of money owing to the large inflow of money into the fund. If you're an existing investor of the 5-star fund, should you be worried? Let's find out. With that, it's back to you, Faye.
Venkata Mahesh has written in Dhirendra. He said he's been investing in this fund, but it closed for subscription last year. He said, how can investors rely or average out their returns when the fund is closed for subscription? What should he do? What should any investor do when the fund suddenly closes for subscription, Dhirendra?
I don't think there is any problem for all SIP investors in this fund, because in all such cases, there have been such instances in the past. There are funds when it gets larger, when they get more money, it becomes difficult. It might be, not good for the fund. It will be beyond manageability, or the valuations are just too high. The fund mandate, this fund is supposed to invest in mid-cap stocks, the emerging blue chip funds. It has done exceptionally well. It has been a top-class fund in all the years. It has been among the top 10 in its category. And of course, the mid-cap itself has been on the forefront in recent past. But this is, the valuations look very stretched. I was looking at this portfolio and looking at, the weighted average PE of assuming this fund was a stock, then its PE will be 23. Given that they are all small-sized mid-cap, and weighted average of 23, and I find that quite a few stocks with a price-earning ratio of 100 and around that, over 50, because with the weighted average, you have all kind of outliers. So the fund manager, in his wisdom, has thought that taking more money will not be good, stock taking. But if you have continued with the SIP, it's fine. And I think you might look back, and I don't know. Only future will prove that whether it's a good step or not. But not taking money at an inopportune time, there might be something in it for you. And if you are committed to investing in mid-cap funds, I don't think there is dearth of opportunity. There are many other credible opportunity, and maybe there are flexible ones. This fund is at just about 3,500 crores, and it has largely remained a mid-cap fund. If you look at the HDFC mid-cap opportunity, which by its very design can invest 30% into large cap and substantially been into mid-cap, and it's a 14,000 crore fund, it can absorb money. So by its very design, it can take more money, and it has not stopped taking money, and it has inbuilt mechanism of the capacity. So you have many great alternatives to choose in this category. This fund, yes, it's good for investors that it has stopped taking money if it thinks it is not appropriate to take it.
So what is your advice right now for investors who are holding this fund? Should they continue to hold it?
I think so. The fund has done it simply for its own convenience, for its inability to deploy the money to generate the kind of return they have done. And I would say that investors should take a lesson from the cue that you can take. And we have also been hinting at it, or not saying very with clarity. But I think most investors, the valuations look very attractive. Investors are getting attracted to small caps and mid caps simply because they have done so well in the past, and investors chase recent past performance. And when valuations look very stressed, then I don't know for how long will it run, but the one becomes vulnerable to any steep correction, and that can shake up this whole momentum. So I would say that investors investing heavily only into small cap and mid caps and being very confident about that, they should rethink about this. They should take a lesson from what this fund has done, that it's not wise to invest in mid caps right now.
All right, so if the fund is closed for subscription, remember it's a wise decision that the fund or the fund manager has taken. It doesn't mean that you need to panic in any way. There are other options, and I'm popping them up on your screen if you want to deploy money right now. But hold on to this fund. Dhirendra, 5 stars then for the Mirae Asset Emerging Bluechip Fund on All Investors Guide as well?
Absolutely, and if you have any continuing SIP, carry on. Looks like it's a privilege for you. But everything, this fund has done well consistently, not only during the period when, all mid caps came on the forefront. Even in the bad times, this fund did very well. So yes, looks a compelling choice, though it has stopped taking money.
Right, that's a compelling choice. And if you have any questions about what you heard, feel free to get in touch with us. Arka Bhattacharjee has written in, Dhirendra, she wants to build a corpus of 1 crore rupees in 20 years. But that aside, her immediate goal, like most Indians, is to buy a home in the next 5 years with a down payment of 15 lakh rupees. She also has a car loan right now that she will pay over the next 6 years. She has no savings, no recurring deposit, no fixed deposit, but she's invested about 2 lakh rupees in balanced funds and equity funds. Is she on the right track? Well, if she wants 2 lakh rupees to turn into 15 lakh rupees over the next 5 years, Dhirendra, she might be slightly off the mark there on that one.
No, 2 lakh rupees in 5 years' time, your own contribution is 10 lakh rupees, and that becoming with a gradual investment, if you're doing it every month, investing about 16,000 rupees a year, every month for the next 5 years, it can well turn into 15 lakh rupees. But what happens to your 1 crore for your retirement? For that, you need to really contribute more. So save more, get started, and buying a house is a negotiable thing. If it turns out to be 15 lakh rupees even before 5 years, then go ahead and realize your investments and get ahead with your plan. But I think retirement will require some careful planning. Think about it, the amount of your consumption need, and you need to really work hard to save that money and invest it aggressively. You have a lot of time on your side. Maybe to begin with, if you start thinking in terms of saving tax and using that, investing in a tax saving fund and earmarking it as your retirement fund, that itself will take care. 15-20 years of regular annual investment of 1.5 lakh rupees additional should translate into a modest retirement corpus for most Indians.
So we're going to wrap up the show here, but what we've learned in this segment is the Mirae Asset Emerging Bluechip, although it's closed for subscription, it's still a good fund to hold on to. If you want to deploy more money, there are other options, but there's no reason to be particularly disappointed with this fund. Invest regularly and increase your contribution over time for each goal. That's a wrap on Investors Guide. Dhirendra, thank you so much for spending time with us. We look forward to catching up with you again next week. Thanks for watching.